All right, good morning, good afternoon, or good evening to everyone. My name is Brendan Williamson. I'm a senior manager of transfer pricing at Forbes Mazars in Richmond, Virginia, in the United States. And today I'll be the moderator. All the participants will be on mute during the webinar, and the webinar is being recorded, so you'll be able to access and replay it on the Forbes Mazars website. During the webinar, please feel free to raise your questions by using the message box at the bottom of the screen. And we'll begin with a quick overview of the context of Pillar 1 Amount B. I'll introduce the presenters in a moment. The tax and transfer pricing landscape has changed over the last few years due to challenges raised by digitalization and globalization. Indeed, traditional international tax rules designed primarily for physical brick and mortar businesses have struggled to address the realities of the modern economy. In this context, the Organization for Economic Cooperation and Development, or OECD, as the inclusive framework on base erosion and profit shifting, or BEPS, has been continuously evolving to develop an agreement on a two-pillar approach to help address tax avoidance, ensure coherence of international tax rules, and ultimately a more transparent tax environment. More specifically, Pillar 1 is comprised of two main key components, namely Amount A and Amount B. Amount A introduces a new taxing right over a portion of residual profits of the largest and most profitable multinational enterprises, replacing the digital services taxes. Amount A applies to large multinationals which meet the threshold of 20 billion euros and a profitability exceeding 10%. Amount A would reallocate certain amounts of taxable income to market jurisdictions, resulting in a change in effective tax rate and cash tax obligations, as well as an impact on current transfer pricing arrangements. Amount B, which is our focus today, is based on a report published by OECD on February 19th, 2024, incorporated as an appendix to Chapter 4 of the OECD guidelines. It aims to simplify and streamline the application of the arm's length principle to in-country baseline marketing and distribution activities, with a particular focus on the needs of low-capacity jurisdictions. There's no specific threshold defined to fall under the scope, and it is a question of activity, unlike Amount A and Pillar 2. This means that all groups are potentially concerned by Amount B, and not only the largest multinational enterprises. Regarding Pillar 2, it aims to establish a global minimum tax of 15%. Its primary goal is to redistribute some of the taxing rights to market jurisdictions where customers and users are located, regardless of where the MNE is headquartered. It's also concerned large multinational enterprises that book consolidated revenues over 750 million euros. This webinar is the opportunity to introduce issues raised by the implementation of Amount B, as well as best practices to be followed. So in addition to myself, I have two other speakers today who are here to talk about the specifics of Amount B. One is Gökçe Güçenayeş, a transfer pricing partner at Forbes Mazars in Turkey, and Lola Liu, transfer pricing senior manager at Forbes Mazars in Tysons Corner, Virginia, in the United States. At the end of the webinar, we'll have a Q&A section, so please feel free to raise your questions using the message box in the bar at the bottom of your screen. Let's have a quick overview of our agenda. First, Gökçe will begin by presenting the scope of Amount B and related transfer pricing methods. The determination of the return on sales under Amount B will then be explained by Lola, and she will talk about the mandatory preparation of transfer pricing documentation, detailing analysis of Amount B. Gökçe will then take the lead again to explain main challenges resulting due to entry into force of Amount B, and she'll offer some concluding thoughts leading into the Q&A. So Gökçe, the floor is yours for the first section, but first I think we're going to have a quick polling question. So the question is, how well did you know Pillar 1 Amount B before this webinar? All right, there you see the results. It seems like we have a good mix, but a lot of people that are unfamiliar or know just a little bit about it. So I'll turn it over to Gökçe to start our introduction here.
Thank you, Brandon, for the great introduction. Hi, all participants. I'm Gökçe. I'm transfer pricing partner at Mazar Türkiye, Istanbul office. And we are now going to start the presentation with the description and the objective of amount P and how jurisdictions may apply this approach and determine the arm's length margin necessary to summarize the ultimate target of amount B. These words would be certainty and simplicity. However, as we will mention during our webinar, this new approach is not that simple legislation in terms of applicability and requires very detailed analysis to avoid certain risks. The development of amount B was a collaborative effort by the OECD and member countries of the Inclusive Framework, or I can say IF countries. We have one core document, which is the OECD report, and one supplementary document, which clarifies the lists that the OECD mentioned as the recommended countries. And the implementation of amount B generally involves redefining the EBIT margin for eligible companies based on specified criteria without requiring any detailed benchmark analysis. The OECD expects taxpayers to apply this approach consistently for at least 3 years, provided conditions remain unchanged. Following the release of the OECD final report, jurisdictions may or may not choose to apply amount B to eligible baseline distributors for fiscal years starting in January 2025, noting that the report may impact jurisdictions which are not members of the Inclusive Framework, but have implemented the OECD TP transfer pricing guidelines within their domestic legislation. In practice, a jurisdiction that chooses to apply the simplified and streamlined approach may choose to apply it using one of two options, which specify which party or parties can assert the simplified and streamlined approach. Under the first option, a jurisdiction can permit tested parties resident within that jurisdiction to select to apply the amount B approach. This option gives more flexibility to multinational enterprises to decide whether to apply the amount B approach or not. Under the second option, a jurisdiction can require the use of simplified and streamlined approach. Thus, the tax administration may specify that taxpayers must apply this approach where the scoping criteria are met, and the tax administration would be bound to apply it under similar circumstances. So the implementation of this approach highlights two main results. The result determined under the simplified and streamlined approach by one jurisdiction will not be binding on the counterparty. So it is underlined by the OECD that taxpayers shouldn't apply the approach to justify the arm's length nature of the remuneration when filing their tax returns in the jurisdictions that do not apply the simplified and streamlined approach. When it comes to the covered jurisdictions, OECD released a list of covered jurisdictions in June 2024. What we see in the list is that the previously defined term of low capacity jurisdictions has been converted to covered jurisdiction to widen the scope. The list covers low and middle income IF jurisdictions and the OECD and G20 member countries that expressed a willingness to apply amount B. It is important to note that any non-IF members that is low or middle income and expresses a willingness to apply amount fee will be added to the list of covered jurisdictions. Thus, the list of covered jurisdictions released by the OECD includes 66 jurisdictions, whom the majority is located in Africa and South America. But please note that this list is a recommended list and does not mean that the listed country jurisdictions will adopt amount B. The list of covered jurisdictions will be reviewed every 5 years, and this will be a mechanical review to revalidate the low and middle income status of the covered jurisdictions based on the latest available World Bank classification. And Ireland is the first country to introduce amount B In October, the Irish government has published a finance bill and confirms that Ireland will respect transfer prices determined under Amount B, where the counterparty jurisdiction is a covered jurisdiction that you see in this list, and Ireland should have a double tax treaty. So let's now focus on the qualifying transactions covered by the Amount B approach. The simplified and streamlined approach under Amount B has been defined to very strict baseline marketing and distribution activities. More specifically, these are considered as qualifying transactions. The first group is buy and sell marketing and distribution transactions, where the distributor purchases goods from one or more associated enterprise for wholesale distribution to unrelated parties, except for the final customer. And the second group is the sales agency and commissioner transactions.
Hang with us for a moment. I think we're having a technical difficulty.
Are economic activities that are distinct from wholesale distribution. So these are not in the scope of Amount B, which, to give an example, manufacturing, financing, research and development. In case of a mixed activity, when a distributor is involved in sale and retail distribution activities, it is considered to be exclusively engaged in wholesale distribution if the retail doesn't exceed the minimum threshold of 20%. So in other words, the wholesale activity must represent a minimum of 80% of the activity. In addition to in-scope activities, a qualifying transaction will be considered as out of scope if the qualifying transaction involves the distribution of non-tangible goods or services or marketing, trading, or distribution of commodities. And if the tested party carries out non-distribution activity, which cannot be evaluated on a separate basis and cannot be reliably priced separately from the non-distribution activities, this means that the qualifying transaction may only remain in scope where it can be adequately evaluated on a separate basis to any non-distribution transaction, which is really the operational challenge of the groups. So once qualifying transactions have been identified, they must still meet some further cumulative criteria and mustn't meet some further alternative criteria to be eligible for the simplified approach. To give you a very general summary for the in-scope transactions, the final report states that the transactional net margin method or comparable profit margin method should be chosen as the most appropriate method under the simplified and streamlined approach. As a very general terminology, Amount B can only be applied for limited risk distributors. Full-fledged distributors are therefore excluded from the scope of Amount B. Now let's look at these cumulative and alternative criteria. Firstly, one-sided method should be the best method, as I mentioned, where the tested party is selected to be the distributor. So based on the available comparable data, TNMM should be the best method chosen for the in-scope transaction. And secondly, but it is also very important, the tested party in the qualifying transaction must not incur an annual operating expenses lower than 3%, or greater than an upper bound of between 20 to 30% of the tested party's annual net revenue. So that we are not expecting a company that does not do anything about OPEX or do most expenditure on OPEX. So in line with the functional analysis outcome, any qualifying transaction will be out of scope if the qualifying transaction involves, as I mentioned, distribution of non-tangible goods, services, or commodities. And commodities are grouped as hydrocarbon mineral, agricultural mineraloid, but to use the time efficiently, I will not go into detail of the commodities section. The most important step, maybe I should say the first step, begins with the industry grouping. industry grouping is the first step when reaching the EBIT margin. Without a need of a benchmark analysis, tested parties should be classified in one of these three groups. And as you can see, there are only three groups to which products are likely to belong. So group 1 includes the perishable foods, grocery, household consumables, construction materials and supplies, plumbing supplies, and metal. Group 2 is the most important one. And as you can see, we can see the industries including IT hardware and components, electrical components, to well-being products and paper and packaging, jewelry, vehicle parts and supplies, and mixed products. And there are many actually different products groups are here. And group 3 is the medical machinery, industrial machinery, including industrial and agricultural vehicles, industrial tools, and industrial components. And please note that group 2 is very important because the products that are not listed in group 1 or group 2 are automatically included in group 2. So about the, yes, I think we have a poll question here.
We have our next polling question on the screen. Does your company have sales and marketing functions or activities in certain jurisdictions? Okay, it looks like the plurality have answered yes, and then some have answered no, and some of our attendees are not sure. We're gonna move next to Lola, who will present on determining arm's length remuneration for Amount B.
Well, thank you, Brandon. In this section, I will do a high-level introduction of the process to determine the level of return for baseline marketing and distribution activities under the Amount B simplified and streamlined approach. Such approach generally involves 3 steps or design elements, that's what OECD calls it, including pricing matrix, operating expense cross-check, and a data availability mechanism for qualifying jurisdictions. So let's talk about the pricing matrix first. The data points in the pricing matrix as shown on this slide is based on a global data set of comparable companies involving baseline marketing and distribution activities developed by OECD for the purpose of approximating arm's length results. So specifically, return on sales has been applied as a net profit indicator for the purpose of establishing the pricing outcomes for in-scope transactions. Basically, all the data points you see here in the pricing matrix here are return on sales numbers. So as you can see in that table, there are 3 of the factors that are relevant to determine the return on sales percentages, including industry groupings and the OAS, which is called net operating asset intensity, and the other one is OES, which is operating expense intensity. So for the industry groupings, Gökçe has already shared detailed information of the 3 industry groupings we usually use under Amount B, and they are shown as the columns, as you can see in the table for the pricing matrix on the slide. Then for the net operating asset intensity, the OAS is defined by OECD as a ratio of net operating assets to the net revenue expressed as a percentage. Then the OES is the operating expense intensity, also is defined by OECD as a ratio of operating expenses to net revenues, also expressed as a percentage. Those 2 ratios will determine the degree of the factor intensity classified between the category A to category E, which represented the roles for the pricing matrix on the slide. So when we calculate those 2 ratios, it is based on the weighted average over the last 3 years prior to the tested year. And in the cases where the tested party, basically that company that performs marketing and distribution, baseline marketing and distribution activities, if that company is newly incorporated or incorporated within less than 3 years from now, then the available financial figures of this company, the tested party, for all these years should be considered for the computation of these two ratios. One nuance to keep in mind is there is a accounts payable 90 days guardrail testing when it comes to the calculation of the OAS. Then when a return on sales number has been determined based on the pricing matrix, it will produce actually a range equal to the ROS plus or minus 0.5% for any subsequent adjustments as needed. So let's talk about an example. So if you think about a company belongs to an industry grouping 2, and the factor intensity classification is B in the table, then we will be able to find that ROS number based on the pricing matrix, which is at intersection of these factors, which is 3.75%. Then, the relevant range basically is going to be 3.25% to 4.25%. That's how the range is calculated. And there's also one nuance to that is in cases where a company belongs to 2 or more industry groupings, weighted average return would be calculated based on the percentage of the sales for the activities under the multiple industry groupings. And we have to keep in mind when we calculate the weighted average return, the sales for the activities under those multiple industry groupings needs to exceed 20% of the total sales of the tested party respectively. Then with that, let's move on to the second step. Basically, after the pricing matrix, what do we do? Is there any adjustment we want to do? So that's the operating expense cross-check we talk about at the very beginning. And that is dependent on which country the tested party is located. So again, that tested party is that company performing the baseline marketing and distribution activities. This step would apply to all in-scope transactions. And what we do is we would evaluate the ratio of the EBIT to the operating expenses of the tested party, which also refers to as return on operating expenses after the pricing matrix, to see whether there are any further adjustments that would be needed. And according to the OECD guidelines, there are 4-step process that we need to go through. The first one is to calculate that return on operating expenses after applying the pricing matrix step. Then we can get a number specifically for the tested party. Then the second step is reliant on the table you guys can see on the slide, where a applicable operating expense cap and collar range needs to be calculated. And if you look at the last column of this table, which says the collar rate is 10%, and this is not going to change for different companies. So that is basically the lower end. Then if we want to calculate the applicable cap rate, that's going to be determined by reference to the factor intensity classification of the tested party. And in this case, if you look at the very first column of the table, that's basically different levels of the net operating asset intensity, either it is high or medium or low. Then the other factor that need to take into consideration is whether the tested party, that company, is subject to default cap rates or alternative cap rates for qualifying jurisdictions. So you will see there are the second column, third column in this table. The first one is related to the default cap rates, and the second one is related to the alternative cap rates. So there is a list of 130 qualifying jurisdictions published by the OECD in June 2024. Basically, if the company is located in a country belongs to that list of the qualifying jurisdictions for this step, then we would use those data in the column for the alternative cap rates. And if that company if that country where the company is located is not in that list of the qualifying jurisdictions, then we would use that default cap rates to calculate the cap rate related to the cap and collar range. Once we have that range, the third step is to compare the return on operating expenses of that company, the tested party, against this range to see whether it is within the range or below the range or above the range. And that brings us to the step 4. Basically, based on our results, certain adjustments might need to be done. And maybe we talk about an example that would make it easier to understand. So let's say we now have a company in a country not in the list of the qualifying jurisdictions. So we're going to use the default cap rates, which is the second column in the table. Then let's think that company actually has a high net operating asset intensity, which is going to be that first row with data points. So based on that, we will know the applicable operating expense cap rate is going to be 70%. Then the collar rate, as I mentioned earlier, that 10% is not going to change. So we have an applicable operating expense cap and collar range of 10% to 70%. Then if in this case, the tested party has let's say 20% operating return on operating expense, then it's within the range. So there's no further adjustment needs to be done for this step. And if there is the tested party's return on operating expense is below the collar rate, let's say it's 8%, then what we need to do is we need to adjust the return on sales number to be able to bring that return on operating expense to the level of the collar rate, which is 10%. And in the cases where if the tested party's return on operating expense result is above 70%, let's say 75%, then what we need to do is actually to adjust the return on sales number for the tested party down to the level of the cap rate, which is 70%. So that is number 4, like the step 4 that needs to go through related to the adjustment for this step. Then moving on to the third step, which we mentioned earlier, is called the data availability mechanism for qualifying jurisdiction. So this step is basically designed to account for the cases where there is no or insufficient data in the global data set for the companies in the qualifying jurisdictions. And I want to clarify, the qualifying jurisdictions here is another set of the qualifying jurisdictions that OECD published in June 2024 specifically for this step. There are some overlapping countries between this list and the list for the step 2 we just talked about. And so for these countries, for those jurisdictions, there might not be a lot of comparable companies out there. So whatever data that collected in the pricing matrix might not well represent the results. So, that's why the data availability mechanism is introduced to kind of cross-correct that. So let's say a company or tested party is located in a qualifying jurisdiction in the list, then the adjustments can be made based on the formula on the left side of the slide that you're looking at. And so if you look at the formula, the adjusted return on sales basically equals to the return on sales number as a result of the step 1 pricing matrix and the step 2 where applicable, plus the net risk adjustment percentage, which, for a given jurisdiction multiplied by the tested party's net operating asset intensity ratio for the relevant period. Then let's talk a little bit more about those 2 items, the net risk adjustment ratio and the operating asset intensity here, because the net risk adjustment percentage is determined by reference to the sovereign credit ratings of the qualifying jurisdiction where the tested party is located. And on the right side of the slide, you will see there is a table basically showing you if we know the sovereign credit rating of the country, we'll be able to identify that net risk adjustment percentage, which can be used in that formula. And for the net operating asset intensity, what I want to point out is for this step specifically, it should not or may not exceed 85% for the purpose of calculating the adjusted return on sales. So these are the general 3 steps included under the amount B simplified streamlined approach. With that, I'm going to turn the floor to Gökçe to talk about the transfer pricing documentation that related to the amount B.
Thank you, Lila. And my internet connection just went bad, so I couldn't give the floor to you, and sorry for that. And as we see, there are many data points during the process once the entity is under the scope. So what are the requirements of applying amount B in terms of transfer pricing documentation? And as for the simplified and streamlined approach, documentation is very important to ensure that the tax administrations have sufficient and reliable information to determine whether the taxpayers' qualifying transactions meet the scope and whether taxpayers have correctly applied the simplified and streamlined approach, as Lola described. And according to the OECD, some of the information may provide useful information in justifying the application of the approach. And what are those? Like explanation of the delineation of the transactions covered, including a functional analysis, written contracts or agreement governing the eligible transaction and corroborating the explanation of the delineation of the transactions covered, the calculations, of course, used to determine the sales, cost, and assets allocated or attributed to the covered transactions, and most importantly, information and allocation tables showing how the financial data used to assess the applicability of the approach and to apply the TP method. These are linked to the annual financial statements. And transfer pricing documentation detailing the analysis of amount B must be prepared and kept valid for a period of 5 years. That is the recommendation of OECD. Unless there is a major change and updated, the reports should be updated annually based on the latest financial data. And in addition, where the taxpayer wishes to apply the approach for the first time, they must include in their local file a consent to apply the approach. But of course, the details should be given in the domestic legislation. And for the first notification procedures, tax authorities will have the option to request this information from the taxpayer. And if the information is not included in the documentation provided, tax authorities will have the authority to ask the taxpayers to provide it as soon as possible. And when it comes to, yes, we have a polling question.
Yep, we have our next polling question up. The question is, has your company done anything internally to prepare for the potential compliance changes brought by Pillar 1 Amount B in the future? Based on our earlier answers, perhaps I should have included an option for unsure, but that's okay. Okay, answers are in. It looks like almost half of the folks have answered not applicable. Perhaps some of those are the unsures. I'm not sure. Thank you very much for responding. And we're going to return here to Gökçe for a discussion of some of the main challenges that this presents.
Yes. And yes, I mean, the main target is to bring certainty, but of course, Amount B certainly contains certain areas where taxpayers may experience challenges. So what are those? Considering that the approach is not binding for all the countries, but requires only a commitment for the outcomes, it is certain that certain mechanisms such as mutual agreement procedures will be highly important in the future, where a tax administration makes a primary adjustment resulting in double taxation of the profits derived from the relevant qualifying transaction. Normally, a corresponding adjustment can mitigate or eliminate double taxation by adjusting downward the tax liability of the related party in a second jurisdiction. And some jurisdictions may be able to remedy economic double taxation through unilateral corresponding adjustments, making use of provisions in their domestic law. However, most jurisdictions would only be able to consider corresponding adjustment as a part of the mutual agreement procedure. And in addition to the potential disputes, there are also tax and accounting issues to be managed. But unfortunately, mutual agreement procedure is not effectively used by every country's tax administration. And although it was one of the mandatory minimum standards under BEPS Action 14, mutual agreement procedure has not reached the desired level of effectiveness in many IF countries. So in this respect, the main challenge seems to be the risk of double taxation. And regarding the tax and accounting issues, as you see in the examples, Amount B requires very strict and auditable income statement or segmented balance sheet and income statement approach. So it should be an issue if the tested party cannot provide with this information to justify the application of this simplified approach. And issues are also raised when there are differences between local accounting standards versus group accounting standards. Because according to OECD, all the calculations should be based on the local accounting standards. And there is a possibility of additional corporate income tax in the covered jurisdiction if the return on sales initially falls below the return on sales computed as a part of Amount B. So this could impact the group's effective tax rate, which is also related with Pillar 2. And if more operating margin are allocated to tested parties located in countries where the corporate tax is higher than the country of the entrepreneur, the group's effective tax rate will be higher. So these are all should be estimated or monitored. And of course, year-end adjustment will be very important during the process. So these are all related with customs and of course VAT. And foreign currency risk is an important criteria for baseline activity. And according to the report, companies should not incur any risk factor in relation to foreign currency to be in the scope. And we are almost reaching to the end. To summarize our key takeaways, the Amount B will be an integral part of the OECD guidelines, and definitely it will change the transfer pricing landscape over the next few years. An Amount B can be anticipated to shift how the tax auditors approach to certain taxpayers. For baseline sales and marketing companies, the entire process leading to the applied margin will be a potential audit point, not just the applied margin itself. So therefore, it shouldn't be considered as a tax audit shelter. And dispute resolution mechanisms such as mutual agreement procedures or APAs will play a crucial role in the effectiveness of this approach. Taxpayers should manage their internal resources for the operational management of Amount B, while all countries, regardless of their classification as covered or not, should work on enhancing the effectiveness of the dispute resolution mechanism. And application of Amount B will require precise and detailed documentation to justify its application on the net margin calculations. And Amount B will trigger a certain number of impacts from a financial and tax perspective. And the main consequences need to be anticipated as soon as possible through financial simulations to determine prospective solutions to limit the negative potential effects. And particular attention should be paid to the publications of the OECD website in the coming weeks. As I mentioned, Ireland is the first country, but of course, many other countries will follow Ireland. So we are very grateful for your participation to our webinar. And I'm hoping that you have gained at least a summary understanding of Amount B in terms of the application and potential impacts. And Brandon, the floor is yours.
So we have one last polling question here, and that is, would you like to schedule time to discuss the topic further with one of today's presenters? I hope you found us friendly enough that you'll say yes. And then we do have a few questions that have come in. So if you still have a question, please don't hesitate to enter it in the box at the bottom of your screen. We'll have a few minutes left to discuss those shortly. Yes, so the first question, I think this will be probably for you, Gökçe, based on the challenges section. The question is, if a US headquartered company has distribution operations in Kenya, but the US does not adopt or implement Pillar 1, will an amount B calculation be needed?
Yeah, that's the tricky part. I mean, as long as US doesn't declare its position, whether they accept it or not, of course, it will not be binding for US. So that is where the double taxation comes from. And it is very important. I didn't mention it. Once there's an arbitration or a trial, always OECD transfer pricing guidelines will be the reference, but not the amount B legislation itself. So it will turn out to defend our case, whether the functional analysis was right, maybe the benchmark will be a supportive document, but as long as both country will not accept amount B, it is always creates a dispute. So the only thing, if a country like Ireland accepts that, if I have a double tax treaty, I accept your consequences and the financial outcome, that is the only way. But if, in the example, US does not accept the amount B, so it will be a very typical TP dispute. That is unfortunately the challenging part of amount B.
And to add to that, I believe when a country passes legislation related to Pillar 1 amount B, there are two options they can offer to the taxpayers related to the calculation. One is they can go down the option of say, hey, taxpayer can voluntarily decide whether they want to adopt or not. Or the other approach, the legislation can say the taxpayer meets the standards, has to take on this approach. So, in this case, if in Kenya they pass that legislation, and if that legislation says you have to do it, then in Kenya you kind of have to go down the path with the amount B approach. Then if it gives you an option, then the taxpayer can, make that decision at their discretion, taking into consideration all the benefits and risks.
That's why I'm really eagerly waiting for a response from African countries. But, there is no any pioneer yet from LATAM or African countries. So we'll see whether, most of them will choose to provide an optional position or they will make it mandatory. So we will all see.
Yeah. And Gökçe, I have a quick question for you. So based on the current development, what kind of timeline do you think we would be looking at related to the amount B, implementations globally?
I mean, actually, it is, 2025, but, it's almost 2025. So Ireland is the only country that they said that, it will be effective starting from 2025. But, if we do not, hear any response from the covered jurisdictions in December time, it should be automatically 2026. Because there is no time to have any preparation. And most of the jurisdictions are very focused with Pillar 2. But I'm expecting to hear at least one or two countries. Otherwise, 25 maybe was a very aggressive year. It was a very short notice. That was, it's my personal opinion. But maybe 26, we will hear most of the countries in the covered jurisdiction to announce in their domestic legislations. That's my, let's say, estimation.
Makes sense. Thank you, Gökçe. Well, I'll turn the floor back to Brandon. I think we might still have one question. Brandon?
Yes, thank you. We had a little bit more technical question regarding some examples in the section for the analysis determining the arm's length remuneration. In the first example, the return on sales was considered as arm's length because the ratio fell within the range of 0.5%. So there were no adjustments that are needed, right? But if, for example, a return on sales were adjusted downward, say to like 3%, does that mean that the taxable profit or the tax liability of the company in that jurisdiction will also be adjusted downward? And if that's true, does this kind of go to one of the challenges that Gökçe mentioned regarding double taxation, or would that treatment raise issues in the counterparty jurisdiction?
But generally speaking, I think, from a practical perspective, and I believe, Brandon, you might be talking about an example that included in a OECD guideline, not necessarily like we went through in details on this webinar, but, from a practical perspective, when it comes to performing downward adjustment due to the local regulations, we always need to be a little bit careful on that. So just want to...
I think I've hear me?
Yes, we can hear you now. Yes, I'm sorry. Essentially, I think the question is that if there is an adjustment downward, will the downward adjustment result in taxable income or liability also being adjusted downward? And if that's true, how would the double taxation be addressed?
Yeah. I mean, of course, as long as it is also adjusted on the counterparty, it is automatically economic double taxation. So that's where the challenges start. But as long as it is adjusted mutually, the only problem becomes the VAT and customs issues and year-end adjustment mechanism. So these are also require some local country-specific regulations. But other than that, if the counterparty doesn't accept to make any adjustment, then the dispute resolution mechanisms such as mutual agreement procedures should work.
Okay, thank you very much. I think that was the last of the questions we have here. So I want to thank again Gökçe and Lola for presenting. Thanks everyone in the audience for tuning in. If you have any further questions, feel free to reach out to us at Forbes Mazars. We can assist you with your Pillar 1 and other transfer pricing concerns. And again, if you would like to review the replay of the webinar, it will be available on the website.
Thank you so much. Bye-bye.
Thank you.
Thank you, guys.